Something happened to your money this morning. You probably didn't notice it. There was no alert on your phone, no headline screaming at you. But while you were pouring your coffee, the value of your retirement account shifted, the interest rate on new mortgages moved, the price you'll pay for groceries next month adjusted slightly upward, all because of a narrow strip of water on the other side of the world. The Strait of Hormuz, 21 miles wide at its narrowest point. 20% of the world's oil flows through it every single day. And right now, the markets are watching that choke point more carefully than they've watched anything in years. Here's what most people don't understand: financial markets don't wait for disasters to happen. They price in the possibility of disaster the moment the risk becomes credible. And when that risk involves the flow of energy, the lifeblood of every economy on earth, the repricing begins immediately. You can already see it if you know where to look. Oil futures climbing, bond yield shifting, inflation expectations adjusting. These aren't predictions about some distant future. They're signals that capital is repositioning right now, today, for a different set of conditions. The damage doesn't wait for the first tanker to sink or the first missile to launch. It begins the moment the market decides the risk is real enough to matter. And that's where we are. This isn't about taking sides in a geopolitical conflict. This is about understanding how systems work, how a bottleneck in one place creates pressure everywhere else, how that pressure moves through energy markets, then into prices, then into interest rates, then into your portfolio, your mortgage, your retirement plan. If you understand the transmission mechanism, the chain that connects a flashpoint in the Middle East to your financial security, you can see what's coming, not with perfect certainty, because no one has that, but with enough clarity to position yourself more intelligently than most people will. So let's walk through it. Step by step, cause and effect, the way it actually works. Here's what history teaches us. Energy shocks follow a script. The actors change. The weapons are different. The political justifications vary. But the underlying sequence, the way the shock moves through the system, remains remarkably consistent. You don't need to memorize every crisis. You just need to recognize the pattern. During the Yom Kippur War in 1973, Arab oil producers decided to cut supplies to countries supporting Israel. Almost overnight, oil prices quadrupled. What followed wasn't just expensive gas, it was a cascade. Inflation jumped from 3% to 12%. The economy contracted. Stock markets collapsed by a third in real terms. People who thought they were financially secure watched their purchasing power evaporate. The lesson wasn't about the war itself. It was about what happens when energy supply gets disrupted. Prices spike. Costs ripple through everything. Central banks react. Growth stops. Wealth gets destroyed. When Iran's revolution shut down production in 1979 and war with Iraq followed, the same sequence unfolded but worse. Oil doubled. U.S. Inflation hit 14%. The Federal Reserve pushed interest rates above 20% to break the inflationary spiral. Millions of Americans with adjustable rate mortgages couldn't make their payments. Housing markets froze. Retirement accounts, built over decades, lost half their real value. Same pattern, same transmission mechanism. Energy shock, inflation surge, policy response, economic contraction, wealth destruction. Iraq's invasion of Kuwait in 1990 and the 2003 invasion of Iraq followed variations of the same script. Supply concerns, price spikes, inflation pressures, policy tightening, recession. It's not the specifics of each crisis that matter. It's the structure underneath. Disruption in energy supply, price shock, generalized inflation, central bank response, economic slowdown, asset repricing. Every link is logical. Every link follows from the one before. And once you see the pattern, you stop being surprised when it repeats. And right now, The early stages of that pattern are activating again. Not because war has broken out, but because the market is pricing in the possibility. And in financial systems, expectations move faster than events. Let me show you how this actually works. Not as abstract theory, but as a chain of cause and effect that you can trace from beginning to end. Think of it like dominoes. Knock over the first one, and the rest fall in sequence. The question isn't whether they'll fall, the question is how fast and how far. When oil prices rise, people think about gas stations. But that's just the most visible part. Energy is embedded in the cost structure of nearly everything you buy. The truck that brings food to your supermarket runs on diesel. The fertilizer that grows that food is made from natural gas. The plastic packaging, the factory that made your clothes, the heat in your building in winter, all of it traces back to energy. So when oil jumps from $75 to $110, it's not just one price going up, it's the foundation shifting under the entire economy. And that shift propagates upward through every layer. Now, here's where geography becomes destiny. The Strait of Hormuz isn't just important, it's structurally irreplaceable. You can't easily reroute that much oil through other pathways. And Iran knows this. They've demonstrated repeatedly through proxy attacks, through threats, through actual military exercises that they're willing to use that leverage. And here's the thing, the market doesn't need an actual blockade to react. It just needs to believe a blockade is possible. Even a 20% probability of disruption is enough to move prices today because traders don't wait for certainty, they position for risk. So oil prices spike. What happens next? Transportation costs rise immediately. Companies that ship goods, whether it's Amazon delivering packages or farmers moving grain, face higher expenses. They pass those costs forward. Manufacturers using energy intensive processes raise their prices. Consumers buying food, clothing, electronics, everything pay more. This isn't inflation in one sector. This is broad based inflation, the kind that doesn't go away quickly because it's baked into the cost structure of production itself. And here's what makes it particularly dangerous. Once inflation expectations shift, they become self reinforcing. Workers demand higher wages. Businesses raise prices to cover those wages. And the spiral accelerates. Now the Federal Reserve has a problem. Their mandate is stable prices and full employment. But when inflation is running at 6% and their target is 2%, they have to act. And they only have one real tool: interest rates, raise rates, make borrowing more expensive, slow down spending and investment, cool demand. Eventually, that brings inflation back down. And this is critical, that cooling process isn't gentle. It means slower growth. It means businesses cutting back. It means stock prices falling because future earnings are worth less. It means bond portfolios losing value. The cure for inflation imposes its own costs, and those costs fall on everyone holding financial assets. Here's where leverage comes back to haunt people. The U.S. government owes over $35 trillion. American households carry trillions more in mortgages, credit cards, student loans, auto loans. When interest rates rise, all of that debt becomes more expensive to service. For the government, it means less money for programs and services. For households, it means less money for everything else after the debt payments are made. For businesses, it means tighter margins and less ability to invest or hire. Debt turns a manageable problem into a crisis because now you're not just dealing with inflation, you're dealing with inflation plus rising debt costs at the same time. And finally, we get to your portfolio. When rates rise and growth slows, financial assets adjust. Stocks fall because future corporate earnings are discounted at higher rates. Bonds fall because older bonds with lower yields become less valuable. Real estate slows because mortgages become less affordable and buyers pull back. Your 401k drops 20%. Your bond fund that you thought was safe loses 8%. Your home equity stagnates or declines. This is the final domino. And by the time it falls, the damage has already cascaded through every prior stage: energy bottleneck, price shock, inflation, rate hikes, debt stress, asset repricing. 6 steps, each one logical, each one following mechanically from the one before. And here's what you need to understand: this chain activates whether or not a full scale war breaks out, because markets price in risk, not reality. The moment the risk becomes credible, the repricing begins. Now, you might be thinking, but what does this actually look like in practice? How bad could it really get? Let me show you. These aren't predictions. Think of them as different versions of the same transmission mechanism, showing how varying levels of disruption flow through the system. I'm going to tell you which scenario is most likely, which is most dangerous, and which is most underestimated, because understanding the range of possibilities is more useful than betting on a single outcome. Limited attacks, sporadic disruptions, no full blockade, no direct war, but enough friction to keep the risk premium elevated. Oil moves from $75 into the mid minus $90s. Not catastrophic, but persistent. Gas prices climb 2, 5, 30%. That's an extra $500. 700 a year just on fuel. Broader inflation edges toward 4 to 5% as transport costs ripple through. The Fed responds with another 50 to 75 basis points of rate increases. Mortgage rates push toward the upper 7% range, slowing housing activity significantly. Equity markets pull back 8-12% as growth forecasts adjust downward. Bond portfolios lose value as yields rise. People on the margin get hurt. Those carrying variable rate debt, those without cash reserves, those who need to sell assets during the drawdown to cover expenses. This is the most likely scenario. It doesn't require catastrophe, just sustained uncertainty. And sustained uncertainty is enough to damage wealth. Iran responds to military action or severe sanctions by making the strait dangerous. Not a full closure, but enough disruption, mines, attacks on tankers, threats that insurance costs spike and some shipments reroute. Oil surges into the $120, 140 range. Gas prices hit $5.50, $6.50 per gallon. Inflation accelerates toward the 6 to 8% range. The Fed moves aggressively, potentially multiple rate hikes over a compressed time frame. Equity markets drop 2-0, 30% as recession fears escalate. Credit markets tighten. Marginal borrowers face stress. Unemployment begins rising as businesses pull back on hiring and investment. Retirees forced to sell during the drawdown get hurt. Small business owners whose margins collapse. Anyone heavily leveraged. This is the most dangerous scenario from a wealth destruction standpoint. It combines high inflation, aggressive monetary tightening, and severe asset repricing all hitting simultaneously. The triple threat we talked about earlier becomes fully active. Direct conflict. The strait is effectively closed or severely restricted. Regional production facilities are targeted. Global oil supply drops significantly. Oil moves well above $150. Gas prices exceed $7 per gallon in many areas. Inflation enters double digits. Emergency policy responses, potential for sharply elevated interest rates. Global recession becomes highly probable. Equity markets could face declines in the 3, 5, 50% range. Credit markets freeze. Corporate defaults rise. Unemployment surges. Everyone gets hurt. This is systemic. This is the most underestimated scenario, not because it's likely, but because people assume it can't happen. That assumption creates complacency, and complacency creates vulnerability when assumptions break. Even the mildest version imposes real costs. Even the manageable scenario erodes wealth through multiple channels over time. And because the market prices in risk before events fully unfold, positioning happens now, not after the damage is done. So, if this is the range of possibilities, how exactly does the damage reach you? How does a crisis in the Middle East translate into less money in your account? Let me show you something most people never think about. Here's what you need to understand about wealth destruction. It doesn't happen just one way. Most people think it's about stock prices falling. And yes, that's part of it, but it's not the whole story, not even close. Wealth is actually destroyed through three channels simultaneously. And when all three channels activate at once, which is exactly what happens during an energy driven inflation shock, the damage compounds in ways that catch people completely off guard. Let me break this down because once you see it, you'll understand why so many people get blindsided. This is the obvious one. Your $500,000 portfolio drops to $400,000. Your bond fund loses value because yields rose. Your real estate equity stagnates or declines because buyers pull back. You can see this one. It shows up in your monthly statement and it hurts. But here's the thing, this is just the first channel. And it's actually not the most insidious. This is the silent killer. Inflation at 6% means everything you buy costs 6% more every year. But your income, if you're retired, doesn't adjust. Your Social Security might adjust slightly, but with a lag. Your pension probably doesn't adjust at all. So if you're living on $60,000 a year and inflation runs at 6%, you've effectively lost $3,600 in purchasing power. The next year, you lose another $3,800. The year after that, more. Over 5 years, that's nearly $20,000 in cumulative purchasing power gone. Even if your account balance never changes, you're getting poorer without realizing it because the number in your account looks the same. But the value behind that number is evaporating. And now the third channel activates. If you're carrying any variable rate debt, credit cards, home equity lines, adjustable mortgages, rising interest rates make that debt more expensive to service. A 2% rate increase on $200,000 in mortgage debt costs you $4,000 more per year. A 4% rate increase on $20,000 in credit card debt costs you $800 more annually. And here's the brutal part. This is happening while your assets are falling and your living costs are rising. Now, put all three together, your portfolio drops 20%. That's $100,000 gone on a $500,000 account. Your purchasing power erodes by $3,600 per year. Your debt costs go up $4,800 per year. In year one alone, you've lost over $108,000 in combined wealth and purchasing power. And that's assuming you don't have to sell assets at depressed prices to cover the shortfall, which would make it even worse. This is why energy shocks are so devastating. They don't just hit one part of your financial life, they hit all three at once. And most people don't see it coming because they're only watching their account balance. They're not calculating the real erosion happening underneath. Now you know. Let's make this even more concrete. I want you to see yourself in one of these three profiles. Because once you recognize which vulnerabilities apply to you, you can start addressing them. Still working, building wealth, probably carrying some debt, focused on getting to retirement with enough saved. Meet Sarah. She's 52, earns $85,000 a year as a project manager, has $340,000 in her 401k, mostly in stock index funds. Carries a $280,000 mortgage and $18,000 in credit card debt from some unexpected medical bills last year. Sarah's income is relatively stable, but her costs aren't. When inflation runs at 6% and her salary increases 3%, she's losing ground every month. Meanwhile, if interest rates rise and her credit card APR jumps from 19% to 23%, she's paying an extra $720 per year just on interest. And if the market drops 25% right when she's 10 years from retirement, that $340,000 becomes $255,000. She has time to recover, but not much. And if she panics and sells, she locks in the loss. She's caught between eroding purchasing power, rising debt costs, and shrinking asset values with limited time to make up the difference. No longer earning, living off savings and fixed income. Time is no longer on their side. Meet Robert. He's 68, retired 3 years ago with $520,000 in his IRA, takes out $32,000 per year to supplement his Social Security. Thought he was set. Robert can't earn more if things go wrong. If his portfolio drops 25%, it's now $390,000. But he still needs that $32,000 per year to live. Now he's withdrawing at a much higher rate, 8.2% instead of 6.2%. At that rate, his money runs out in 14 years instead of 25. And if inflation is running at 6%, his real purchasing power is eroding every single year. Worse, if he's forced to sell during the drawdown to fund living expenses, he can't wait for recovery. The loss becomes permanent, no time buffer, no income flexibility. Wealth destruction is immediate and often irreversible. Running a business on tight margins, exposed to cost fluctuations, dependent on consumer spending. Meet Linda. She owns a small landscaping company with 6 employees. Fuel costs are a major expense. When diesel jumps 40%, her operating costs spike immediately. Linda can't easily pass those costs to customers without losing business to competitors. Meanwhile, her customers dealing with their own inflation squeeze start cutting back on landscaping services. So her revenue drops just as her costs surge. And if she has a business loan at a variable rate, rising interest rates make that debt more expensive right when her margins are getting crushed. She's squeezed from both sides, higher costs, lower revenue, while her cost of capital increases. Many small businesses don't survive this combination. Each archetype faces the same fundamental mismatch. Something they can't control moves faster than something they can control, and that mismatch is where the damage happens. So now you understand how the damage happens and who it hits hardest. The question becomes, what do you actually do about it? Let me give you a framework, not generic advice, but a system based on principles. Before we get into tactics, let me say this clearly. I'm not your financial advisor. I don't know your specific situation, your risk tolerance, your timeline, or your goals. What I'm about to describe is a strategic framework, a way of thinking about defense that you can adapt to your own circumstances. But here's the principle that underlies everything. In a world where you can't predict exactly what will happen, the goal isn't to be right about the future. The goal is to build a system that survives multiple possible futures. That's what this is. The first layer is existential. It's about making sure that a sudden market move or cost spike doesn't force you into decisions you can't reverse. Cash reserves, 6 to 12 months of living expenses, liquid, accessible, not invested in anything volatile. This is your buffer that prevents forced selling when markets are down. Debt reduction, focus on high cost, variable rate debt. Credit cards charging 20%. Home equity lines tied to prime rate. Adjustable mortgages. These become traps when rates rise. Eliminate them or convert them to fixed rates if possible. Expense flexibility. Know which expenses are truly fixed and which can be reduced in a crisis. The more flexibility you have, the less you're forced to liquidate assets at bad prices. You can absorb a shock without being pushed into irreversible financial damage. The second layer is about positioning. It's about reducing your exposure to the specific risks that energy shocks and inflation create. Diversification across asset classes. Don't put everything in equities. Hold some exposure to assets that behave differently during inflationary periods, commodities, inflation protected securities, real assets, perhaps some exposure to energy stocks that benefit when oil prices rise. This isn't about maximizing returns in any one scenario. It's about ensuring that no single scenario destroys you. Income diversification. If possible, don't depend entirely on one income source. Side income, rental property, dividend paying investments, anything that reduces your concentration risk, inflation sensitive positions. Some assets do well when inflation accelerates. Having some exposure acts as a natural hedge against the scenario you're most worried about. Your financial structure can withstand different economic conditions without catastrophic loss. The third layer is about optionality. It's about keeping yourself flexible enough to adjust as conditions evolve. Avoid over leverage. Excessive debt reduces your options. When rates rise, leverage turns from an amplifier of gains into a source of stress. Keep debt manageable relative to income and assets. Maintain skills and learning. For those still working, continuous skill development increases your ability to adapt to changing conditions. For business owners, operational flexibility and cost discipline increase survival odds. Behavioral discipline. The biggest wealth destroyer isn't market volatility, it's emotional decision making. Selling at the bottom, buying back near the top, overreacting to headlines. Have a framework. Trust the framework. Don't let panic override logic. You remain adaptable. You don't lock yourself into positions that can't adjust as the world changes. Survival protects you from acute damage. Stability reduces vulnerability to systemic shocks. Resilience keeps you flexible for the long term. It's not a checklist, it's a system. And systems are more robust than individual tactics because each layer reinforces the others. Let me bring this home. The connection between war and your wealth isn't mysterious. It's mechanical. Energy flows through a choke point. That choke point becomes vulnerable. Markets price in the vulnerability. Prices adjust. Inflation follows. Central banks respond. Debt gets more expensive. Assets reprice downward. It's a chain. And once you see the chain, you understand that the outcomes aren't random, they're structural. The situation unfolding now with Iran isn't new. It's a variation of a pattern we've seen before 1973, 1979, 1990. The actors change, the weapons differ, but the underlying mechanism remains the same. And here's the most important insight: you don't need to predict the exact outcome. You don't need to know whether it'll be scenario one, two, or three. You don't need to guess the peak oil price or the exact Fed response. What you need is to understand the transmission mechanism and then position yourself so that you can survive and even thrive across a range of possible futures. That's what Dalio has always taught. The goal isn't certainty. The goal is robust positioning, diversification not just of assets, but of vulnerabilities, liquidity, so you're never forced to sell at the worst time, discipline, so you don't let fear override strategy. You can't control geopolitics. You can't control oil markets. You can't control central bank policy, but you can control your exposure, your debt levels, your cash reserves, your diversification, your response. And in a world where expectations move faster than events, where the damage begins before the physical disruption even occurs, that control is the only real edge you have. The war has already started. affecting your wallet, not in some future hypothetical scenario. Right now, today, in the subtle repricing happening in markets around the world, the question isn't whether you'll be affected. The question is whether you've built a system that can withstand what comes next. Because preparation, not prediction, is what separates those who survive from those who don't. Position accordingly.